Visa Installments functions as a specialized technology feature rather than a standalone application, allowing cardholders to break down large purchases into equal, manageable payments directly through an existing Visa credit card. When a shopper reaches the checkout counter or an online payment page, they can select the installments option using the card they already carry. It is important to realize that eligibility depends entirely on the issuing bank, such as Chase or Wells Fargo, and not all Visa cards will have this feature activated. One of the most significant logistical facts is that this service does not require a new credit check or a hard pull because it utilizes the credit line already established. However, a critical detail to keep in mind is that the full amount of the purchase is typically deducted from the available credit immediately. Even though the repayment happens over time, that portion of the credit limit remains occupied until the balance is paid down. The costs and fees associated with these plans are determined by the specific bank, often appearing as either a fixed monthly fee or a specific annual percentage rate or APR tailored to the installment plan. These payments are then integrated seamlessly into the regular monthly credit card statement. The convenience of this system is hard to ignore because it eliminates the need to download additional apps, create new accounts, or manage multiple passwords across different services. It simplifies financial management by keeping everything within a single existing bank ecosystem. Because there is no hard credit check, consumers can avoid the typical dings to their credit score that come with opening new lines of credit. There is a high level of transparency here that standard credit card revolving balances lack. Instead of dealing with fluctuating minimum payments and compounding interest that feels never-ending, the installment plan provides a clear monthly cost and a definitive end date from the very beginning. Furthermore, users often get to keep their standard rewards like points or miles on the full purchase price and maintain their usual purchase protections, which is a massive win for those who prioritize travel or cashback benefits. On the other hand, there are distinct drawbacks that require a cautious approach. The fact that it locks up the existing credit limit is a major factor to consider. If someone has a $5,000 limit and spends $2,000 on a new computer using installments, their available credit drops to $3,000 instantly. This can lead to a higher credit utilization ratio, which might temporarily lower a credit score if the balance is high compared to the total limit. There is also the issue of inconsistent availability, as the service only works if both the bank and the retailer have opted into the technology. While some might hope for a free service, many banks apply a monthly fee or an installment-specific APR, which could potentially make the purchase just as expensive as carrying a standard balance if the user is not diligent. Additionally, returning an item can become a complex headache, as reversing an installment plan and getting the credit back onto the card is often more cumbersome than a standard refund. This tool is a solid middle ground for those who want a structured loan without the hassle of a new application, but it is not for everyone. It is an excellent choice for anyone looking to avoid new credit inquiries or seeking a fixed payoff date for a major purchase to avoid the trap of revolving debt. However, for those who are already near their credit limit, this could trigger over-limit fees or negatively impact their credit standing. If a different buy now pay later service offers a 0% interest rate while the bank charges an APR or a fee, the outside service is clearly the better financial move. Ultimately, the simplicity of using a card that is already in the wallet is the main draw, but users must stay aware of how it affects their overall credit health. In summary, Visa Installments offers a streamlined way to manage big costs by using an existing credit line without new apps or hard credit pulls, which provides great transparency and rewards retention. However, the risks involve a significant reduction in available credit, potential interest or fees through the bank-specific APR, and a possible temporary hit to a credit score due to high utilization.